Okay, here we are again. We are still in Chapter 1. This is probably going to be our last class period where the whole class period will be on Chapter 1. Okay, so we are getting towards the end of it. And I will tell you this, I spend probably a longer amount of time in Chapters 1 and Chapters 2 than a lot of instructors because I feel it's so important to lay that strong foundation for the rest of the class from Chapters 1 and 2. Okay, so we probably won't spend as much time on every chapter in this book during the semester, but we probably will on Chapters 1 and 2. Okay, you still have a little while before your test, so I'll give you plenty of notice when that's coming up, so you can plan accordingly. I'm never going to be the sort of instructor who says, and you need to take the test, in the next 2 days, or next class period, or whatever. So I'll always give you ample warning. Okay. All right. What I want to do today is, I hope everybody did their homework. Did you get a chance to work on the homework? Okay. For you folks at home, I hope you did it as well, because the way you learn this stuff is by doing it. How many times have I said that, right? Let's go through Quick Study 111 first. Okay. Quick Study 111. Now, Quick Study 111 is a real common test sort of question. Okay. Now, last period, we went over the financial statements, correct? We went through that, right? A skill that you want to hone and make sure that you're good at is being able to look at an account and knowing what financial statement it goes on. Okay, so if I show you accounts payable, oh, that goes on the balance sheet, that's a revenue. If I show you telephone expense, that's an expense that goes on the income statement. Okay, if I show you withdrawals, that goes on the statement of equity. Okay, it's a very, very common test question. Okay, because I think you need to know where these financial statements, what accounts these financial statements belong on. Okay, so let's take a look at Quick Study 111. Indicate the financial statement each item would most likely appear on: income statement, balance sheet, statement of owner's equity, or statement of cash flows. Okay, all right. So letter A, equipment would be on what? Balance sheet, right? It's an asset. What about expenses? Income statement. Income statement. Okay, liabilities would be on the balance sheet. The net decrease or increase in cash, that's actually on the cash flow statement. Okay, not as worried about that one because, again, preparing the cash flow statement is not something we're going to do in this class, something you'll probably do in accounting 2 if you take that. Yeah, we didn't really cover that, but they don't know that when they wrote this exercise. So, revenues go on the income statement. Total liabilities and equity on the balance sheet. Assets, balance sheet. Cash from operating activities is on the cash flow statement. Don't worry about that one. And then withdrawals is on the statement of owner's equity. Okay? All right, you might write yourself a little note, though, that's a common test question. All right? Any questions on that? Okay, what I'm going to do now is I want to talk real quickly through the principles of accounting. Let me switch over to the PowerPoint here in a second. We had talked about the revenue recognition principle, right? Okay? But I don't believe we talked about the other principles, correct? So let's do that right now. Okay, let me switch over to the PowerPoint. All right, the revenue recognition principle. Let me just review this one because it's so important. We recognize revenue when it is earned. When is it earned? When we provided the product or the service, correct? Okay, it does not matter when the cash comes in. Okay? Does not matter when the cash comes in. We recognize revenue when it is earned. When is it earned? When we have provided the product or the service. Okay? Now I want to show you one real quick thing and introduce a new account to you today. I'm going to go over to the Elmo. Okay? Remember when we were talking about if I get money, let's say that I am a landscaper. Okay? Peter, let's say that I agree to mow your lawn for $50. Okay? And let's say that you go ahead and pay me $50 today, but I tell you I'm not going to be able to get to your lawn until next week. You with me? Now that $50 that Peter hands me, $50 cash, is that earned or is that not earned? It's not earned because I have not yet mowed the lawn. Okay, so how would we account for that in sort of a transaction analysis sort of way? That's what I want to talk about. Okay? So let's take a look at the Elmo. Well, what I would do when he handed me that $50 is I would increase cash by $50. And then what I would also increase is an account called unearned revenue. Unearned revenue. Okay? And I would increase that by $50. That's exactly right. This is important. This is a common mistake by students. This is a liability account. Okay? That is not a revenue account. It is a liability account. So where do you think it goes? Which financial statement? Where do all liabilities go? The balance sheet. Okay? Unearned revenue is not a revenue account. It is a liability account. Okay? And that is what we would increase when Peter gives me $50 to mow a lawn that I have not yet mowed. Okay? Because it is a liability to Peter, right? Think about this. I owe Peter one of two things, right? I either owe you a lawn mowing, or what if I decide to disband my business, or I got to give you your $50 back, right? Mm-hmm. So I have a liability from me to Peter. Okay? Unearned revenue is a liability account, not a revenue account. Okay? Now let's talk about the transaction that would occur while we're on this situation. What's the transaction that would occur when I get done mowing that lawn? Well, what would happen then is, let me see if I can sneak it in here. Actually, let me do this. When I mow that lawn, unearned revenue would go down because that liability has been decreased. And revenue, earned revenue, would go up. Does that make sense? Because I have, in essence, satisfied that liability. Do you understand that? Okay? Make sense? Okay. All right. So, going back to the revenue recognition principle, I wanted to point out what that account is specifically. I will tell you, on tests and quizzes and stuff, the most common error is people try to put unearned revenue on the income statement. Okay? And it needs to go on the balance sheet with the liabilities. Okay, let's talk about these other principles. Now, these principles are not the rules of accounting, but like they're the foundation of accounting of which the rules are based on. Okay? The more the overlying principles. Okay. The cost principle. What is the cost principle? Well, what that is this. Let's say Brian, it's Brian, right? Brian, let's say that you bought a delivery vehicle, a used delivery vehicle for your business, okay? Maybe a pickup truck or something, okay? And let's say that you paid $8,000 cash for it, okay? But you know you got a great deal on it. You know you got a great deal on it. If you look at the Blue Book value, or if you talk to a banker, if you talk to mechanics, everybody's telling you, hey, this truck, you got a great deal. This truck that you paid $8,000 for is probably worth $10,000. You got a great deal, okay? Now, when you go to record that asset in your books, what amount are you going to put it on the books at? You're going to put it on the books at $8,000, okay? Because that was the true cost. If you look at the check that you wrote, it says 8000, right? Yeah. And this is we want to be objective when we record our assets, because really, you could think the truck is worth $10,000. You could think the truck is worth $11,000. You may think it's worth $7,800, that he didn't get a good deal, right? Do you see how subjective it would be if we just put assets on the books at whatever we feel like they're worth, right? So no, if you wrote the check for $8,000, and if that was your cost, that's what you recorded as. Make sense? That's the cost principle. Okay? All right, what about the full disclosure principle? The full disclosure principle, a company is required to report the details behind financial statements that would impact users' decisions. Well, what does that mean? Well, it means just what it says, and I want to show you something here in your book. Okay? Turn in. It's probably going to be in the middle of the book if you have the textbook with work papers in it. And I'm going to put over show you what I'm looking at. You're not going to be able to read it, but you can at least see what I'm looking at. Okay. This is on pages A2 and A3 in your book. It's in the appendix in the very back. Okay. Okay. Yeah, Zach found it. Okay. You got it. Okay, if you're not finding it, look at your neighbor. But this is the actual financial reports for Best Buy. Okay, we've all bought a couple DVDs there or something, right? Now, if you look at that on page A3, A4, A5, those are your financial statements, right? Okay. But look on page A8, notes to the consolidated financial statements. And the full disclosure principle states that if the information is important to the user in making decisions, that we need to tell them about it, okay? And you can kind of, take a minute or two sometime and kind of thumb through those notes to the financial statements. But it tells you all sorts of things. The very first note is usually about what the business does, okay? And some of their significant accounting policies, what their fiscal year is, and all sorts of information like that. As a matter of fact, if you ever are thinking about investing in a company, or if ever in your academic career you are researching a company and you request the annual report, it's often believed that the best way to study a company is not to look at the financial statements first, but to look at the notes to the financial statements. Okay? Has anybody ever got an annual report or seen an annual report? Sometimes they're kind of glossy and nice. Read the notes before you actually look at the financial statements when you're researching a company, okay? But those notes are a good example, one example of the full disclosure principle, where a company is required to report the details behind the financial statements, okay? Comprendo? All right, the next principle is the matching principle. I'm not going to concentrate too much on this right now. I don't want you to worry about this one too much. I'm going to address this one more in Chapter 3. But the matching principle, real quickly, is that you want to record the expenses in the same periods as those that, let me see what the best way to say that. We want to record expenses in the periods in which they helped create revenue. Okay? And like I said, let's not worry about that one too much right now, because I think it's going to go to some principles and some issues that we haven't really discussed yet. So let's come back to the matching principle in Chapter 3, all right? But let's go on to the next slide of principles. The going concern principle, or going concern assumptions. What that means is that when you read financial statements, you can assume that the preparers of those financial statements feel that the company is going to continue on. If they felt like it was going to be closed down or sold or go bankrupt, you have to disclose that in the financial statement notes. Okay? So the going concern, though, is when you look at financial statements, you can assume that that company is going to continue going on, continue operating, if it's not stated otherwise. Okay? The monetary unit assumption. That simply means that we express transactions and events in monetary or money units, okay? And when we were doing this example up on the Elmo, switching real quick back to it, we were talking about $50, $50, $50, right? Okay? We record things in monetary units, okay? Now, that doesn't always have to be the dollar. If we're in Japan, it'll be the yen. If we're in Holland, it'll be the euro. But it's in some sort of monetary unit, okay? The time period assumption. That simply means that we can break down or divide time periods, our company's operations into time periods, such as we can look at a year or quarter or month. Remember how we talked about on the financial statements last time, how the income statement is going to say for the month ended or for the year ended or whatever, correct? That's what it's saying, is that we can break that down into those time periods. And then lastly, the business entity assumption. What is that saying? Well, what that is saying is if you have a business, you need to account for it separately from your personal records or from other businesses that you might have, okay? So Gil, let's say that you have a computer consulting business, okay? You're going to keep the records for that computer consulting business totally separate from your personal life. You don't want to be writing checks out of the same checkbook and all that, okay? You don't want all that stuff just mingled up together. You want to keep track of your business here and your personal life here. And if you have another business, you want to keep track of it separately. It needs to be its own separate business entity. Does that make sense? Okay? Not too hard a one. Okay? Those are the principles. Are there any questions about that? And one thing that you might do in this class, just so if you have a question, I don't mean to be overly formal, but if you have a little longer question or something, you might just shoot up your hand, and that way that they can turn the audio on so that you can be heard, okay? As opposed to just blurting something out, they may not have a chance, okay? But not if you just have a quick comment or a quick question, but if you have a longer question, okay? Are there any questions about these? These make sense? Let's take a look at Quick Study 1.5, which I assigned. And to have done that, you really had to read because we hadn't gone over the principles yet. But that's okay. Let's go through it now. Okay? Quick Study 1.5. Identify the accounting principle or assumption that best describes each of the following practices. In December of 2009, Ace Landscaping received a customer's order and cash prepayment to install sod at a new house that would not be ready for installation until March 2010. Ace should record the revenue from the customer order in March of 2010, not in December of 2009. What principle is that? Revenue recognition principle. We recognize revenue when it is earned. When is it earned? When we provided the product or service, not necessarily when the cash comes in. B, if $51,000 cash is paid to buy land, then by golly, the land is reported on the buyer's balance sheet at $51,000. Cost principle for B. C, J. Karen owns both Sailing Passions and Dockside Supplies. In preparing financial statements for Dockside Supplies, Karen makes sure that the expense transactions of Sailing Passions are kept separate from Dockside statements. This is the business entity principle, which we just discussed. Cool? All right. Questions on that? Any questions on that? Okay. Okay. Well, if there's no questions on that, let's go ahead and go to exercises 113, 114, 115. And that was where you had to prepare the financial statements, correct? Okay. So let's go ahead and do that. Let's go ahead and do that. Okay. Now, switching over to the Elmo, I'm going to photocopy this so I could write on it. I'm going to blow it up here. Did you have something that looked a little bit like this? Right? That's exercise 113. And what it says is, on October the 1st, Keisha King organized Real Answers, a new consulting firm. On October 31st, the company's records showed the following items and amounts. Use this information to prepare the October income statement for the business. And we know that eventually they ask us to do the statement of equity and then the balance sheet, right? And you need to do them in that order, right? Income statement first, statement equity second, balance sheet third. Okay? Well, here is the first thing that I always do when I have to do financial statements in this manner. Okay? Is I go through each account, and just like Quick Study 111, I write what financial statement that these are going to go on. Now, they've made it pretty easy for us. They've made it pretty easy for us because they grouped them all together, right? But cash goes on the balance sheet, right? So does accounts receivable, office supplies, land, equipment, and payables. Those all go on the balance sheet, correct? You with me? Okay. Owner's investments. When you invest money, that goes on the statement of equity, right? Just write SE for statement of equity. Going over to this side, cash withdrawals by owner, that also goes on the statement of equity, doesn't it? Correct? What about consulting fees earned? What type of account is that? That's a revenue, right? Revenue account. So that goes on the income statement, right? And all these expenses go on there as well. You with me? So what I did is I identified all the accounts and what financial statement that they go on. Okay? Now we're going to come back to this little list in a second here. But the first thing that we're going to do is do the income statement. Okay, none of those go on the income statement. So we're going to start over here. Okay? Those go on the income statement. All right? So let's take a look at what that is going to look like. Exercise 113. Okay? All right. Well, the first thing that you want to do is you want to make sure, let me get this. Let me get that there. The first thing that you want to do is make sure you prepare this in good form. What does that mean? That means that you head it up correctly, okay? You put the name of the company, the name of the statement, and you date it properly. Now, if you would have dated this just October 31st, that's wrong, okay? And if you did that on a test, I'd lovingly take a point off because I care about you, okay? Because that doesn't make any sense. Oh, we talk about the year, the month, the day, the week, the quarter, what? We have to say for the month ended, October 31st, okay? Well, that income statement is going to look like this. The revenues, there's only one. Here's the expenses, total expenses, and then your net income is $45.40. Now, your income statement might look slightly different, okay? And there's some wiggle room as far as how these look. You may not have done these in a left column and these in a right column. That's fine, okay? Everybody's is going to probably look slightly different. That's okay, as long as, it, you know, generally speaking, the message is the same, okay? So that is the income statement. How many people got that? Anybody? Did you guys get that? Okay, good, good. All right, any questions on the income statement before we go to the next one? Lauren.
I'm having a hard time figuring out what exactly goes on it. Like, I have 26,000 instead of 14 for the revenue because I think I put accounts receivable.
Yeah. Okay, that's a common thing. Accounts receivable is not an additional revenue account that you have to put on there. The accounts receivable stuff is already in that revenue. Okay? Let me give you an example that will clarify. For simplicity's sake, let's say you only had one revenue transaction for a given period, okay? And let's say you recorded it like this. Whoops. Let's say that you provided $2,000 worth of services to a client on account. Okay? We're going to analyze the transaction. We provide $2,000 worth of services on account to a customer. Now, we provided the services, so it's revenue. Well, what we would do is accounts receivable would go up by $2,000, right? And revenue would go up by $2,000. Okay? Let's say that's the only transaction we had in regards to revenue for a month, okay? And now we're doing the income statement. Okay? Well, going back to that Elmo, do you see where we would only record revenue of $2,000? The revenue is not $4,000. That would be double counting it. Does that make sense, Lauren? So if you add the receivable amount to whatever the stated revenue is, you're kind of double counting things.
Does that count for expenses or the accounts payable that you owe? Are those already counted?
Accounts payable won't have anything to do with revenues.
Okay.
But you really, when you are looking at the revenue accounts.
It's like
for expenses?
I added that to expenses too.
Same situation.
Okay.
You don't go over to the AP, just look at the expense accounts.
Okay.
Does this make sense? It's a great question. It's a great question. Otherwise, you're going to end up double counting some stuff. You with me? Okay, good. And what I'm going to do at the end of this period is I'm going to give you another assignment of preparing financial statements, because this is something I promise you have to do on the first test. This is one of the most important things that we'll learn from this class. Okay? Great questions. Great questions. Okay. There we are back to our income statement. What other questions do you have on that? Any other questions? Okay, well, let's go to what's the next statement they want us to prepare? Statement of owner's equity. Okay? And that one is right below. Now, we're also going to head that up and prepare it in proper form. These are always going to look the same between the statement of equity and the income statement, the headings. Once again, not October 31st, but for the month ended. Okay? So let me go ahead and show you what that looks like. Okay? Where did we get this net income? Where did we get that? From preparing our net income statement. Okay? So that is why we have to prepare the income statement first, because that's where that comes from. Okay? Our beginning balance of capital is 0. Now let me say something important here. Seems like all the examples that the book gives us, it's always a brand new business. And so the beginning balance of capital on the statement of equity is always 0. That's usually only the case for the very first month or whatever period of time that you start the business. Okay? So going back to the statement of equity, please don't think that that's always going to be 0. As a matter of fact, when we do a statement of equity for the month ended November 30th, when we do that next month, what do you think the beginning balance of capital is going to be? It's going to be $86,900. That will be the beginning balance of capital. Does that make sense? Think of it this way. Think of your checking account. Have you ever received your checking bank statement? And it says your beginning balance of cash plus your deposits minus your withdrawals equals your ending balance of cash, right? And then this month's ending balance of cash becomes the next month's beginning balance of cash, right? Chances are the only bank statement that the beginning balance of cash was exactly 0 was when you opened the account, correct? All right? Same thing with the statement of equity. So please don't get the idea that the beginning balance of capital is always 0. Okay, so we added the investments by the owner of $84,360. We added the net income that we got from up here. We subtract out the withdrawals, and that gives us our ending balance of capital. Now, sometimes people will have this account called capital, parentheses, king, or sometimes they will put the name king and then capital, okay? Again, there is some wiggle room in accounting. So you just kind of need to be familiar with it both ways. The same way with withdrawals, okay? All right, Brian.
So if you did, so if there's 2 people in on this.
Okay,
That's where the name would.
Okay,
come in.
yes. But I'm glad you said that. What you're saying is if there's two people. Okay. Now remember from our very beginning of this chapter, if there's two people, it's going to be either a partnership or corporation, right? Pretty much what we're going to be talking about this whole semester, 99% of the time is a sole proprietorship. So this is for sole proprietorship. There's one owner. There's only one capital account. Yes, rushing forward way ahead to the first chapter we cover in accounting 2. Yes, you're right. But I don't want to even begin to introduce too many partnership accounting principles now. Let's just focus on sole proprietorships. But yeah, that's why you put the name. That's why you put the name. Okay? Good question. But remember, keep sole proprietorship. Sole proprietorship. Keep that in your brain right now for the whole semester. Cool? All right, any other questions? These are great questions you guys are asking. Any other questions on statement of equity or income statement? If not, what's the next financial statement?
Balance sheet.
The balance sheet. And that goes right here, correct? Let's go ahead. Let's date that properly. Now remember, we say the name of the company, we say the name of the financial statement, and then we date it properly, okay? Now this one should say either October 31st or as of October 31st. If you said for the month ended October 31st, I would lovingly take a point off on your test, okay? Because technically it's not right, okay? These are only the balances of these assets and liabilities as of October 31st, not for every day of that month. Does that make sense? That may seem really picky, but I want to go ahead. It's just as easy to learn the right way, and so I want to go ahead and make that a point of emphasis. All right. The balance sheet is called the balance sheet because we want to make sure the accounting equation balances. Here are your assets, okay? Here are your liabilities. I'm sorry, here's your liability. There's only one. Here's your ending balance of capital, okay? Now, where did we get that? Where did we get our ending balance of capital? We got it from the statement of equity, didn't we? That's why you have to prepare them in that order. Okay? The ending balance of capital is calculated in the statement of equity. Make sense? Another thing I want to make sure that you do. Let's just look at the asset side. Make sure that you total it up. Don't just have that. Okay? No, I want a total there. And not only do I want a total there, but I don't want it like that either. I want you to go ahead and label that total assets. Same thing over here. Don't just put that. Put the total and put the title. Because that's going to give your readers of the financial statements a nice warm feeling in their tummy that the accounting equation balances. Okay? So go ahead and total those up. Total assets. Total up liability and equity. Total liabilities and equity. And by golly, those two numbers better equal the same. Correct? All right? How do you guys do on those? You do okay? That's all right. I appreciate your honesty. As I always say, when you make an error on your homework, that's a good thing. Because that's an error that you would have made on the test, but you just got it out of the way, right? If you wouldn't have done your homework, you'd have made that error on the test. But now you made it on your homework, you learned from it, correct?
I put accounts receivable as a revenue at first.
Yeah, that's a common deal. It's a common deal. It's a common deal. Don't worry about that, okay? All right, the other thing that I want to show you that I do, and I'm going to go back to this little list that I showed you, okay? Now, what I would have done, and I didn't do it because I didn't want to keep breaking from it, but once I identified which accounts go on which statement, as I used those on an income statement, as I used those on a financial statement that I was preparing, I circle them. Okay? I circle them. Okay? So once I did my income statement, I would and put those 5 accounts on there, I would circle those. Then when I did my statement of equity, I used investments, and then I used cash withdrawals by owner. And then when I prepared my balance sheet, I put my assets and then I circle those, and then I put my liabilities, okay? Why do I do that? I do that because if I don't do that, I usually miss one. I usually forget to put one there. Are you with me? Now, they were very nice in the sense that they grouped all of the accounts pretty much together. Thus, all the balance sheet accounts were together, and all of the income statement and so on. Okay? But what we're going to do now, and we're not going to have time to complete the whole thing, but we're going to start working on something in class. Now, this is the Valentine tree trimming handout that you should have. Okay? Look in your blue book, the one with the piggy bank on the front. Looks like this. Okay? And one of the very first pages in there should look like this, and it's the below our accounts for August 2009 for Valentine tree trimming. Okay? Everybody have that? Does everybody have this book here in class? Okay? Did anybody forget to bring their book? Okay, I'll get you an extra copy. Why don't you hand this back to Lauren? Anybody else? You can just keep that. Okay? Now, I want to show you something on this one. Now, I will tell you right now, this is a former test question. Okay? But what did I do differently when I listed the accounts here? How is this different than what you did on your homework? I alphabetized them. So they're all mixed up. They're all mixed up. So the first thing that you should do is go through these. Where does accounts payable? Balance sheet. Where's accounts receivable? Balance sheet. Where's advertising expense? Income statement. Where's cash? Balance sheet. And so on. Okay? You need to do that. Now, do you see where the necessity of circling these accounts as you use them would be even more important here? Okay? So what I want to do is, we're not going to have time to do all three statements, but I at least want to get you started. I want you to at least get through the income statement. But we're going to work on that here in class while they play their music. Okay? And for you folks at home, just do exactly what we're doing. You can pause it, or you can let the music play. But I want you to start working on Valentine tree trimming financial statements, okay? So let's go ahead and do that. I want you to at least get through the income statement by the time we're done with class, okay? Let's go ahead and do that. Okay. Hey, you maybe didn't get done with all three. I'd be surprised if you did. But hopefully you at least got done with the income statement. Let's go ahead and switch over and, see, I need to push that. No. Okay. Can you see that, guys? That is the answer to the income statement. Okay. I dated it properly. Make sure that you do your heading. Okay. Don't get in the habit of just going right to the numbers. No, I want you to do that heading. I want you to prepare it in proper form because I'll take points off that for the test, okay? Here's your revenues. Here's your expenses. Here's your net income of $7,040, okay? $7,040. Does that make sense? Okay? So, any questions on that? You didn't try to stick unearned revenue on there, did you? Because that's a liability that goes on the balance sheet account, okay? But that is the answer to the income statement for Valentine tree trimming. How many people got that? Raise your hand. Okay, good. Okay, what I want to do now then is quickly give you your homework, okay? And what I want to do is let's go ahead and stay on the Excel spreadsheet because what I want to show you is I'm going to give you a couple check figures, okay? The ending balance of capital, now this is all for Valentine. I want you to finish that handout. The ending balance of capital should be $31,540, okay? And on the balance sheets, the total assets should be $34,020, okay? Those are just check figures, okay? Because what I want your homework to be this, I want you to finish the Valentine handout, okay? I want you to do exercise 1.5. Now that actually has to do with the different forms of business. And I didn't sign that earlier. I looked over it and I kind of like it. So I'm going to go ahead and sign that one, okay? So I want you to do exercise 1.5. Maybe I can blow this up a little bit more so you can see it a little bit better. Okay? And then the last thing I want you to do is read about return on assets in your book. It's at the very last part of the chapter. And do exercise 118. Okay? So that is your homework assignment. There are your check figures for Valentine. And that should give you what you need to do. Okay? We will see you next time. Good job, guys.